Imagine two people walking into the exact same dealership on the exact same Saturday morning. They're both 32 years old. They both live in Dallas. They both earn $85,000 a year. They both have excellent credit, and they both have exactly $40,000 sitting in savings. By the time they leave, they're driving home in the exact same brand new SUV with a sticker price of $40,000. Jason pays cash. Ryan finances the entire purchase. Ask almost anyone which one made the smarter financial decision, and you'll probably hear the same answer. Jason avoided interest. Ryan willingly signed up to pay a bank thousands of dollars more. Jason thinks he won. Ryan thinks he made the smarter move. Here's the strange part. They're both wrong, because neither one of them actually measured the number that matters most. And by the end of this video, the difference between their financial futures isn't going to come from the car itself. It isn't even going to come from the interest rate. It's going to come from one decision almost nobody pays attention to. A decision that quietly compounds for years, while everyone else is arguing about cash versus financing. And once you see the math, you may never look at buying a car the same way again. So let's make this as fair as possible. Same city, same age, same income, same credit score, same vehicle, same starting savings. The only thing will change is how they pay for the car, because feelings and math are two very different things. Jason has spent years hearing one piece of advice. If you can't pay cash, you can't afford it. So when he walks into the dealership, he writes a check for the full $40,000. No monthly payment, no interest, no bank. He drives away feeling completely free. Ryan hears a different piece of advice. Keep your cash working. Instead of handing over his savings, he finances the full purchase. Let's say he qualifies for a 60-month loan at 4.9% APR. His monthly payment comes to about $753. Over 5 years, he'll pay roughly $45,180. That's about $5,180 in interest. At first glance, the comparison looks embarrassingly easy. Jason spent $40,000. Ryan spends more than $45,000. Game over. Except, that's only one side of the equation. Because Ryan's $40,000 didn't disappear. It stayed in his account. And he made one promise to himself. Every dollar that wasn't used to buy the car would stay invested instead of sitting idle. Now, before anyone says investing is guaranteed, it isn't. Markets move up. Markets move down. Returns are never certain. But historically, broad U.S. stock market index funds have produced average long-term annual returns around 10% before inflation over many decades. Past performance never guarantees future results, but it's a reasonable benchmark for comparison. So we'll use something more conservative. An average annual return of 8%, not because that's guaranteed, simply because it gives us a realistic long-term example. Meanwhile, Jason has something Ryan doesn't. Peace of mind. He never worries about making a car payment. He never sees money leaving his checking account every month. Psychologically, that feels incredible, and that's worth acknowledging. Financial decisions aren't made by spreadsheets. They're made by people. People like certainty. People like simplicity. People like saying, I own my car outright. That's real value. But feelings don't erase opportunity cost. Opportunity cost is simply what your money could have done if you had used it differently. It's the invisible bill that never arrives in your mailbox. On day one, Jason's savings account falls from $40,000 to zero. Ryan's account still holds $40,000. Same car, completely different balance sheet. Now let's fast forward 1 year. Jason has no loan. Ryan has made 12 monthly payments totaling just over $9,000. Of those payments, roughly $7,300 reduced the loan balance. The rest, about $1,700, went toward interest. That's the number most people focus on. Ryan lost $1,700. Sounds painful, but remember the other side. If Ryan's invested money earned approximately 8% over that same year, his original $40,000 grows to about $43,200 before accounting for taxes or investment expenses. Even after paying around $1,700 in interest, his investments have earned roughly $3,200. On paper, that's a gain of about $1,500. Sounds great, until you subtract everything else. Because owning a car comes with costs that don't care how you paid for it. Sales tax, registration, insurance, maintenance, depreciation. Let's assume they're in Texas. Sales tax alone can easily add around 6.25% or roughly $2,500 on a $40,000 vehicle before local fees. Registration and documentation fees might add another $300 to $700 depending on where you buy. Insurance? For many drivers in their early 30s with clean records, full coverage on a new SUV can easily run between $1,800 and $2,500 per year. Maintenance during the first year might only be a few $100s, maybe an oil change, maybe tire rotations, nothing dramatic. And then there's depreciation, the cost almost nobody feels because nobody writes a check for it. According to Consumer Reports and industry valuation data, many new vehicles lose roughly 20% of their value during the first year alone. On a $40,000 SUV, that's around $8,000. Think about that. Jason avoided paying $1,700 in interest, but the vehicle itself may have quietly lost around $8,000 in value during exactly the same period. Ryan paid interest. Jason paid depreciation. Both lost money, just in completely different ways. That's why focusing on only one number almost always leads people to the wrong conclusion. Now let's move to year 3. Jason still loves telling people he owns his vehicle outright. And technically, he's right. Ryan still has a loan balance, but it's shrinking every month. After roughly 36 payments, Ryan has paid about $27,100 in total. Around $24,000 has gone toward principal. The remaining balance is now roughly $16,000. During those same 3 years, if Ryan's investments averaged that same hypothetical 8% annual return, his original $40,000 has grown to just over $50,000 before taxes. That's more than $10,000 in investment growth. Again, on paper that sounds fantastic, until you subtract everything else. Market volatility, taxes on investment gains if sold, the emotional stress of watching your portfolio fall during bad years, and the discipline required not to spend that money. Because here's the part almost nobody tells you. Ryan only wins this comparison if he actually keeps the money invested. If he finances the car, leaves the dealership, and 6 months later spends that $40,000 on vacations, furniture, gadgets, or lifestyle upgrades, the math collapses. Suddenly he's paying interest without owning the appreciating asset that was supposed to offset it. That's the difference between strategy and justification. One creates wealth, the other simply creates debt. And that's where this story starts getting interesting. Because by year 5, the numbers begin moving in a direction that surprises almost everyone. By the 5th year, Jason and Ryan finally arrive at the same milestone. The car loan is gone. Ryan makes his 60th and final payment. Jason hasn't made a payment in 5 years. If you only looked at their checking accounts, you'd probably say Jason had the better experience. No monthly obligation. No lender. No interest charges appearing every single month. There's real value in that. Cash flow isn't just math. It's emotional. A required payment changes the way people think, especially during stressful periods. But now it's time to stop looking at monthly payments and start looking at net worth. Jason owns a 5-year-old SUV that's now worth somewhere between $19,000 and $24,000, depending on mileage, condition, and the model's resale value. Ryan owns the exact same SUV, same mileage, same depreciation, same market value. The car doesn't care how it was paid for. The difference isn't sitting in the driveway. It's sitting on the balance sheet. If Ryan consistently left that original $40,000 invested and earned an average annual return of 8%, it has grown to roughly $58,800 before taxes. Remember, he paid approximately $5,180 in total interest over those 5 years. Subtract that interest cost, and the investment growth is still worth far more than the financing expense. On paper, Ryan appears to be ahead. Sounds great, until you subtract everything else, because investments aren't free. If Ryan invested in a taxable brokerage account, capital gains taxes may apply whenever he sells appreciated assets. If he panicked during a market downturn and sold after a 20% decline, the entire strategy could fail. Investment management fees, even a seemingly tiny 1% annual advisory fee, can reduce ending wealth by thousands of dollars over long periods. And inflation quietly changes the purchasing power of every dollar both men own. Money has friction. Every strategy has friction. The question isn't whether friction exists. It's which kind you're choosing. This is usually the point where the internet argument begins. One side says, never finance a depreciating asset. The other says, never tie up cash in something losing value. Both statements sound intelligent. Neither one tells the whole story. Because neither one asks the most important question. What could that money have earned somewhere else? That's the opportunity cost. And opportunity cost rarely feels expensive because nobody sends you a bill for it. Let's move ahead another 5 years. Year 10. Both SUVs have now become ordinary used vehicles. They're probably worth somewhere between $10,000 and $15,000, depending on maintenance, mileage, accident history, and market demand. Depreciation has slowed dramatically compared to those painful first few years. Maintenance, however, has started moving in the opposite direction. Brake jobs, new tires, battery replacements, suspension components, unexpected repairs. Consumer Reports has consistently found that maintenance and repair costs generally increase significantly as vehicles age, especially after warranty coverage expires. Over years 6 through 10, many owners spend somewhere between $4,000 and $8,000 on maintenance and repairs, depending on reliability and mileage. Jason pays them. Ryan pays them too. Again, the car doesn't care who financed it. Insurance has probably become cheaper. Maybe it drops from around $2,200 per year to closer to $1,500. Registration costs continue. Fuel continues. Nothing about paying cash eliminated those expenses. But Ryan's investment account has kept working. At an average 8% annual return, that original $40,000 has now grown to roughly $86,000 before taxes. That's more than doubling the original amount. Not because Ryan picked brilliant stocks. Not because he timed the market. Simply because time kept showing up. That's what compound growth does. It looks boring. Until suddenly, it doesn't. And this is the flip point. For the first several years, Jason felt like the winner. He avoided interest. He owned his vehicle outright. Friends probably congratulated him for being responsible. Ryan looked like the guy paying unnecessary finance charges. But somewhere between years 5 and 10, the story quietly reversed. Not because financing is magical, not because paying cash is foolish, because the investment returns eventually became larger than the financing cost. The numbers, not the emotions, changed the outcome. And that's why timing matters. People often compare day 1 decisions while completely ignoring year 10 consequences. Now let's talk about the number almost everybody brags about. I paid cash. People say it proudly. And there's nothing wrong with that. But it's only one sentence in a much longer financial story. Here's what almost nobody talks about. First, dealer holdback. Many manufacturers quietly pay dealerships a percentage of the vehicle's MSRP after it's sold, often around 2% to 3%. It's part of how dealers make money, even if they appear to discount the car heavily. The buyer rarely sees this number. Second, finance and insurance profit. Walk into the finance office, and you're no longer just discussing a loan. You're being offered extended warranties, gap insurance, paint protection, maintenance plans, wheel protection. According to public filings from major dealership groups such as AutoNation and Lithia Motors, finance and insurance products represent a meaningful source of dealership profit, sometimes thousands of dollars per vehicle. That's why dealerships often care more about how you finance than whether you finance. Third, documentation fees. They're often called doc fees. Depending on the state and dealership, these can range anywhere from around $200 to well over $1,000. Many buyers negotiate the vehicle price, but forget the paperwork fees. Fourth, depreciation. The invisible giant. We've already talked about the first-year drop, but over 10 years, many vehicles lose around 70% to 80% of their original value. That's usually a much larger expense than interest ever was. Finally, opportunity cost. The quietest number of them all. Jason never wrote a check for opportunity cost. Ryan never received an invoice for it. But over a decade, it may have been the biggest number in the entire comparison. Now let's be fair. If I only showed you the downsides of paying cash, I'd be doing exactly what so many finance influencers do when they free trying to win an argument instead of explain reality. There are absolutely situations where paying cash is the better move. Suppose interest rates aren't 4.9%. Suppose they're 9%, 10%, or even higher. Suddenly, the guaranteed savings from avoiding interest become much more valuable. Or maybe your investments would only earn 4% while your auto loan costs 8%. The math flips immediately. Another example. Maybe you're close to retirement and simply value certainty over maximizing expected returns. A paid-off vehicle lowers monthly obligations. That can reduce financial stress dramatically. Or perhaps you're self-employed with highly unpredictable income. Removing a required monthly payment can provide flexibility during slower business months. That's a legitimate benefit. Cash flow matters. Risk tolerance matters. Sleep matters. Those aren't spreadsheet variables, but they affect real people every single day. At the same time, financing only works under very specific conditions. You need a relatively low interest rate. You need excellent financial discipline. Most importantly, you must actually invest the cash instead of spending it. Miss even one of those conditions, and financing can become the more expensive decision surprisingly quickly. So this isn't really a debate between cash and financing. It's a debate between intentional investing and accidental spending. And those are two completely different conversations. Now let's stretch the timeline even further. Because 5 years isn't where financial decisions become obvious. 10 years isn't either. Real wealth usually shows itself after decades, not months. Fast forward to year 20. Neither Jason nor Ryan still owns that original SUV. Realistically, they both replaced it years ago. Let's assume each of them follows the exact same pattern every 10 years. They buy another $40,000 vehicle adjusted for inflation, keep it for a decade, then replace it. Jason continues paying cash every single time. Ryan continues using low-rate financing whenever it's available, while keeping the equivalent purchase amount invested. Now the small differences begin stacking on top of each other. This is where compounding becomes difficult for our brains to understand. It's no longer about one car. It's about repeating the same financial habit over and over. If Ryan consistently earned an average annual return of 8% while financing each purchase at approximately 4% to 5%, his long-term investment portfolio could reasonably end up somewhere between $170,000 and $240,000 larger than Jason's after 20 years, depending on taxes, market performance, and the exact loan terms. Notice what I didn't say. I didn't say financing always creates an extra $200,000. I said it can, under a very specific set of conditions, because change just one variable, and the outcome changes dramatically. Suppose average investment returns fall to 5%. Suppose auto loan rates rise to 8%. Suppose Ryan misses just 12 months of investing because life gets in the way. That six-figure advantage can shrink dramatically. That's why the biggest mistake isn't choosing cash. It isn't choosing financing. It's assuming today's conditions will stay the same forever. Markets change. Interest rates change. Your income changes. The math has to change with them. There's another number people rarely calculate. Liquidity. Jason's $40,000 became a vehicle. Ryan's $40,000 remained available. If either of them suddenly lost their jobs 6 months after buying the SUV, their situations would look very different. Jason owns his vehicle outright. That's valuable. But if he needs cash, selling the car isn't always fast or convenient. Ryan still has cash invested. He may have access to emergency savings without immediately selling the vehicle. Of course, investments can also fall in value during a recession. That's the trade-off. Liquidity isn't free. Neither is certainty. Every financial decision is simply exchanging one type of risk for another. Now let's ground this in real-world data. According to the FDIC, money held in insured deposit accounts is protected up to the applicable insurance limits at member banks. That makes savings accounts extremely safe. But historically, they're also unlikely to produce stock market-like returns over long periods. According to the IRS, auto loan interest for a personal use vehicle generally isn't tax-deductible. That means most buyers pay that interest with after-tax dollars. And according to Consumer Reports, depreciation remains one of the largest ownership costs throughout a vehicle's life, often exceeding maintenance expenses during the early years. Those aren't opinions. They're simply facts. Now here's the practical strategy that almost nobody at the dealership explains. Step 1. Negotiate the purchase price before discussing how you're paying. Many buyers immediately announce they're paying cash. That sounds powerful, but dealerships often make significant profit from financing and finance office products. Sometimes they're willing to discount the vehicle more aggressively if they believe they'll earn money through financing later. Keep the conversation focused on the out-the-door price first. Taxes, registration, documentation fees, everything included. Only after that number is finalized should you discuss payment. Step 2. Compare the financing rate with what your money could realistically earn. Not hopefully. Realistically, if you're being offered a 2.9% promotional loan, while high-quality short-term treasury ETFs or other conservative investments are yielding a similar or higher amount, the decision deserves a closer look. If the loan is 8% and your investments are expected to earn about the same, or less, the advantage may disappear. Run the numbers. Don't rely on slogans. Step 3. If you choose financing because you want your cash invested, Actually invest it. Not next month. Not after vacation. Not after buying new furniture. Immediately. The strategy only works if the money stays invested. Otherwise, you've simply added interest without creating an appreciating asset to offset it. That's not leverage. That's lifestyle inflation. Here's one more scenario that completely changes the math. Imagine Ryan invests just an additional $200 every month, alongside keeping that original $40,000 invested. At an average annual return of 8%, 20 years later, that extra monthly contribution alone grows to roughly $118,000. Not because $200 is a magical number, because consistency compounds. Small monthly decisions often matter more than dramatic one-time decisions. Meanwhile, imagine Jason takes the money he would have spent on monthly loan payments and invests that amount every month after paying cash. Suddenly, the gap narrows again. Maybe it even disappears. That's the point. There isn't one universal answer. There are only better answers for specific situations. Jason and Ryan both walked away from the dealership, believing they'd made the smart play. Jason believed avoiding interest automatically meant he won. Ryan believed financing automatically made him smarter. Neither one actually ran the complete numbers. Jason underestimated opportunity cost. Ryan underestimated the discipline required to make his strategy work. And that's the lesson most financial debates completely miss. The real trap isn't paying cash. The real trap isn't financing. The real trap is making the decision based on hype, headlines, internet advice, or someone else's opinion instead of running the numbers for your own situation. Because the correct answer depends on your interest rate, your expected investment return, your emergency savings, your job stability, your risk tolerance, your spending habits. Change any one of those variables, and the math changes too. The smartest financial decision isn't the one that sounds impressive at a barbecue. It's the one that improves your net worth after every hidden cost has been included. Not just interest, not just depreciation, everything. And if you're wondering what happens when leasing, financing, and paying cash are all compared side by side under the exact same assumptions, that's a completely different conversation. One that might completely change the way you think about your next vehicle. Did you include everything? Because the answer that includes everything is the only answer that matters. If this video helped you see something you didn't know was there, subscribe to Wealth Blueprint and hit the notification bell. We break down the hidden math behind the financial decisions you face every day.